Well, good afternoon, everybody, and welcome to this event on fiscal risks and sustainability. I'm Paul Johnson, Director of the IFS, and I will be chairing today's event. We've got three speakers. We're kicking off with Richard Hughes, who I'm sure you all know is Chairman of the Office of Budget Responsibility. He will be talking about the OBR's fiscal risks report, and I think with the message that debt is something we ought to be worried about. Carl Emmerson will talk largely around a paper we published today looking at a particular type of fiscal risk, which is that chancellors have tended to behave asymmetrically when different kinds of economic news arrives, with the result that we've ratcheted up the size of the state and borrowing and debt over the last decade and a bit. And finally, Bruna Skarica from Morgan Stanley will be talking about the financial market's response to debt and borrowing. This is an event in the run-up to our main green budget, which is being published in just under 3 weeks' time. And the work at the IFS, we're very grateful to the Nuffield Foundation for funding that. We, as ever, have the Slido app, which you should have access to, where you can put any questions. There should be plenty of time for questions to the panel after they have each spoken. And if you like a question that someone else has put in there, please do vote it up, because those ones towards the top are the ones I will see first and are most likely to ask. I will stop the introductions at that point and hand over to Richard, and we'll hand directly between Richard and Carl and Bruna without me coming in between.
Great. Thank you, Paul. Let me just share my slides and get that going. And let me say thank you very much indeed for the invitation to be here. And it's great to be with the IFS and Bruna talking about our most recent report on fiscal risks and sustainability. I thought I might start with just some background on our fiscal risks and sustainability reports. They're a report that we do every summer in between our biannual economic and fiscal outlooks, which set out our 5-year forecast for the economy and public finances. And they focus on the threats to the fiscal outlook, which are not captured in those medium-term forecasts, either because they're near-term risks, like recessions, like pandemics, like geopolitical risks, which are unlikely to happen in any given 5-year period, but are certain to come along at some point. So they're not in our central 5-year forecast, but they're potential threats to those 5-year forecasts. Or they're long-term pressures, things like aging, things like climate change, things like changes in the pattern of global trade, whose effects loom beyond the end of our 5-year forecast period, but are likely to affect the economic and fiscal position once you look 10, 20, 50 years ahead. Our most recent report, which was published in July of this year, looked at risks arising from 3 areas: inactivity and health, and in particular, the rise in long-term sickness in the wake of the pandemic and what that means for the labour market. Secondly, we looked at changes in the cost and composition of the UK's energy supply. And then finally, we looked at the stock of government debt and its sustainability in the new interest rate environment. And it's on this last topic that I wanted to focus in this presentation, and which I think is also of most immediate relevance to the other presentations you're going to hear about this afternoon. Why focus on public debt at this moment? Well, one reason is we have a lot more of it than we used to. Public debt has now tripled from under 30% of GDP at the beginning of the century to almost 100% of GDP today. The second is that public debt tends to be where most other risks in the economy and society end up. If you look over the last 20 years, about 3/4 of the increase in debt that we've seen since the start of the century occurred in just 6 years, and those are the ones following the financial crisis, then following the pandemic, and then following the energy crisis. So the government's debt stock is a kind of financial repository of past fiscal traumas, which tend to build up and add to it over time. And so if you want to understand, why, where fiscal risks manifest themselves, looking at the history of government debt is quite a good place to find them. And then the third reason to focus on debt in particular at this moment in time is not just because we have a lot of it, but it's become a lot more expensive to have. And that is because interest rates have risen dramatically over the course of the last 18 months, from close to zero during the pandemic to over 4% today. And what that does is just increase the cost of having that debt. Debt interest as a share of government revenue, so the amount we're spending servicing our debt as a share of government resources, has more than doubled. And also is set to more than double from around 3% in 2020-21 to 7.8% by the time we get 5 years out toward the latter half of this decade. And so what I'm going to do is to try and persuade you that current levels of debt are something worth worrying about. And I think my way of doing that is going to be to try and debunk 5 reasons that are commonly given for why our current levels of debt are not a problem. And starting with something that a number of people have said, which is that, well, don't worry, we've had 100% of debt to GDP ratio before in our history, so having debt that's gotten back to 100% of GDP roughly is not something we should be particularly worried about. And on its face, this is a true statement. We have had debt close to or above 200% of GDP, both at the end of the Napoleonic Wars back in 1815, and also, as you can see from this chart, at the end of the Second World War in 1945. But it's important to bear in mind, I guess, 2 things you can see from this chart. One is that it took about a century to get rid of the debt burden that we had built up by the end of the Napoleonic Wars in 1815. And while it happened a lot faster, that debt reduction after 1945, as you can see from the much steeper line on this chart, post 1945 and into the second half of the 20th century, that was partly thanks to a number of fiscal tailwinds, which have largely blown themselves out by now and may even become fiscal headwinds in the future. So the future is unlikely to be the past, which was much more amenable to debt reduction. And to give you a sense of why that's the case, the first thing to focus on is demographics, and in particular, the fact that the big period of debt reduction that we saw after the end of the Second World War coincided with the post-war baby boom, which meant that there were a lot more net contributors than net recipients of public support in the early post-war years. And what you can see here is a chart of the age structure of the UK population at 3 snapshots in time, 50 years ago in the early 1970s, today, and then in 50 years' time in the early 1970s. And what you can see is that in the 1970s, at the sort of peak of the baby boom, there are around 4 people of working age for every 1 person in retirement. Today, that's fallen to around 3 people of working age for every 1 person in retirement. And by the time we get out to the 2070s, there are only going to be 2 people of working age for every 1 person in retirement. So the ratio of people who are net recipients of fiscal support in the form of pensions and healthcare is falling dramatically compared to the ratio of people who are of contributing to the cost of public services in the form of taxation. And as you can also see from the grey block on this chart, the fastest increase in the population that's expected to happen over the next 50 years are in those people who are 85 years and older, who are more likely to have multiple complex healthcare needs and whose health has generally not been improving in recent years, unlike that of the rest of the population. A second post-war fiscal tailwind that risks becoming a headwind is the global security situation. As you can see from this chart, one of the key things that allowed for the dramatic expansion of the post-war welfare state over the period post-1945, without jeopardizing fiscal sustainability over that period, has been a steady decline in defense spending, which fell from around 10% of GDP at the end of the Korean War to the NATO minimum of around 2% of GDP at the end of the Cold War. This 8% of GDP reduction in the size of the warfare state has created and almost exactly equaled the offsetting increase in the size of the welfare state, which grew over this period, as you can see from this chart, and got an additional boost during the pandemic from things like the coronavirus job retention scheme. And so if we keep current obligations to pay tax and entitlements to public services unchanged, and we're not getting that benefit from falling defense spending, but holding it constant over the next 50 years, the aging of the population generates a growing gap between how much we're bringing in tax and how much is going out in spending, in particular on the welfare state. Spending rises by around 10% of GDP just from demographics alone, and the cost of providing healthcare and a state pension to an aging population. The increase in health spending accounts for about 7 percentage points of GDP in that rise. The rise in the state pension accounts for another 3 percentage points in total public spending over that period. And if you hold receipts roughly steady at around 40% of GDP, this results in a growing primary deficit, which reaches around 10% of GDP by the time we get to the 2070s. And this steady increase in the size of the primary deficit, the gap between the amount we're bringing in revenues and the amount we're spending, in particular on health and pensions, pushes our debt up to anywhere between 300 and 450% of GDP by the time we get out to the 2070s, which is higher than anything we've seen in the past, including in the aftermath of the Napoleonic Wars and including in the aftermath of the Second World. A second reason people give for not worrying about our current level of debt is, well, they say, well, look around the world, lots of other countries nowadays have debt to GDP ratios of around 100% of GDP in debt. And as you can see from this chart, once again, on its face, that's a true statement. Lots of other G7 countries, including the US, France, and Italy, now have more than 100% of GDP worth of government debt. And Japan, a big outlier, has over 200% of GDP worth of debt these days. But what you can also see is that up until recently, we've been a relatively low debt country in the UK. We were actually in the sort of in only the second quartile of countries, whereas we're now headed up toward the top quartile of the most indebted advanced economies, and well above the average. And another thing which has happened in the meantime that renders our debt position more vulnerable than it's been in the past is the growing share of our debt that's held abroad. Over the past 20 years, the share of UK government debt in foreign hands has almost doubled from around 13% to 25%, and is now the second highest in the G7 after France. Kind of why does that matter? It matters because it leaves the UK's cost of borrowing and public finances more generally vulnerable to sudden changes in investor sentiment amongst global investors around the world, who are particularly wedded to the idea of having sterling-denominated assets, unlike UK residents. As we saw an illustration this time last year, when we saw our currency falling while our interest rates rose. This is a risk that countries like the US and Japan are less exposed to because more of their government debt is held domestically, and presumably those domestic investors want to hang on to US dollar or yen denominated assets to offset any liabilities that they have. A third reason people give for not worrying too much about the large stock of debt that we have is the claim that we have a long average maturity of debt. And this is meant to insulate the UK's public finances from sudden changes in interest rates, such as we've seen in the recent past, because it's like being on a long-term fixed-rate mortgage. Once again, this is something which used to be true, and also if you looked only at the volume of gilts and other debt instruments issued by the Treasury, whose average maturity, if you look at the green line on the left, has indeed been steadily rising from around 5 years to around 8 years across the whole of the portfolio of debt issued by the Treasury. The problem with just looking at that green line, however, is that it ignores something else which has happened since 2008, which is quantitative easing by the Bank of England, which has been operationalized by the bank going around buying up lots of that long-term debt issued by the Treasury and replacing it in exchange for very short-term debt issued by the bank, which pays a floating or overnight rate of interest. And the net effect of those quantitative easing operations has been to shorten the average maturity of the consolidated liabilities of the UK public sector, putting together both the Treasury and the Bank of England as a whole, from 7 years down to 2 years, which is what you can see on the yellow line there. And as you can see on the right, this has doubled the sensitivity of the UK's interest payments to a given change in market interest rates. So we're much more exposed to short-term changes in interest rates because so much more of our average debt is now paying that short-term interest rate through the liabilities of the Bank of England rather than the long-term debt instruments that used to be out there in the market. A fourth reason some people have given for not worrying about how much debt we have is that we can always inflate it away, like we did in the past. One of the things that was bringing down our debt to GDP ratio quite quickly over the post-war years was relatively high rates of inflation. And we have indeed, over the last year, seen inflation hit a 40-year high, going back up to double digits. But again, this is something which used to be true, but is no longer the case. And that is because starting in the 1980s, the UK government started issuing inflation or index-linked debt, whose value rises and falls with the rate of inflation. And the stock of this debt has grown to account for around 1/4 of our total debt stock, which is twice as much as the next largest inflation-linked issuer, which is Italy. And what that means is that inflation doesn't actually help to erode the value of our debt away at all, and the value of our debt just adjusts exactly for the inflation rate. And the combined impact of the UK debt stock's relatively short average maturity and heightened sensitivity to inflation can be seen in the fact that while everyone's interest rates have gone up a lot over the last few years, all over the G7, our interest costs have risen twice as fast as that of any other G7 country over the last 3 years. And so turning to a final reason why some people give for not worrying about our currently elevated level of debt is that, well, we've had a run of bad luck over the last few years. We've had a financial crisis, we've had a pandemic, we've had an energy crisis. We're due some good luck soon. But this hoping that something will turn up attitude ignores a number of worrying patterns in the nature of fiscal shocks of the 21st century. The first is that major shocks seem to become more frequent, with 3 so-called once-in-a-generation shocks occurring in just one generation in the past 20 years. The second is these shocks seem to become more costly to the public finances. A rule of thumb that we used to have in the UK is that a typical recession adds around 10% of GDP to government borrowing, the stock of government debt, over the course of that recession. But the last 3 shocks have seen the cost have an average cost of around 20% of GDP in terms of the addition that they've added to the government debt stock. So shocks are becoming more frequent as well as more expensive. And a final reason to worry from the point of view of debt sustainability is that even where governments do face some good news or positive shocks, the government's reaction to those shocks is very different from the way in which they respond to bad news. And I think that provides a nice segue over to the work the IFS published today, which Carl's going to present next.
Thank you very much, Richard. So I'm going to talk about an issue around how central do we think the OBR's forecasts are, what reasons we might have for thinking that we might expect borrowing to turn out differently to what those forecasts suggest. And I'm going to turn, as Richard says, to talk about some of the work that we published today, which talks about how do chancellors react when they're handed with good news and how do chancellors react when they're handed with bad news in terms of the medium-term outlook for the public finances. That's going to matter for how we might think future shocks will translate into what happens to borrowing and debt going forward. So under the latest forecasts that the Chancellor released...
Sorry, Carl, you're not currently sharing your screen.
How's that? So under the latest forecast produced at the time of the March budget, it showed that the Chancellor was complying with his fiscal target to have debt falling at the end of the forecast horizon, but only just complying with that. So debt was only falling very, very slightly in the 5th year. Now, those forecasts produced by Richard and his colleagues at the OBR are intended to be a central forecast. So it's meant to be equally likely that things will turn out better or worse than that forecast. But to produce a forecast, you need to know what government policy is going to be, and those forecasts are produced on the basis of what government policy is stated to be. And what I'm going to argue in this talk is some of the reasons why we might think that government policy perhaps won't evolve as stated, and why that might lend us to believe that actually borrowing is going to be higher than what is forecast. So just to start with some of the classic examples that people always suggest, one is fuel duties. So if we go back to June 2010, the government told the OBR at the time, yes, we're going to increase fuel duties each year in line with the RPI. And the green line here shows you what the rate of fuel duty would have been had that in fact occurred. What's happened since then is essentially each chancellor has said, well, I'm going to freeze fuel duties just for 1 year, and then I'll go back to RPI indexation honest. And that's the forecast that's been produced each time that's happened. Now, if we look at the latest forecast, you can see that followed by the red line here. That says that not only are we going to increase fuel duties in line with the RPI going forwards, we're also going to allow a temporary 5p cut to expire. So that's a 5p cut that was put in place for 1 year. It's then extended for 2 years. The forecasts are predicated on that expiring and then us returning to RPI indexation following that red line. I think much more likely, given this revealed behaviour since 2010, is that the 5p cut will become permanent and actually will continue to freeze rates at their current level. That would reduce revenues going forward and add to borrowing. Now, that's not the only example. There's several others. The Chancellor has penciled in spending totals beyond March 2025. He hasn't set detailed plans for each government department. He's just penciled in the totals. And what we know from past behaviour since 2010 is that when you actually get to a spending review, when the Treasury has the task of dividing the cake up between different government departments, at that moment, there's been a tendency for chancellors over that period to top up those spending plans. And the OBR tells us that the average upwards revision made at spending review since 2010 is equal to £14 billion per year. That's not an inconsiderable risk to the deficit forecast. And there's several others kicking around. We hear lots of policy statements being made about things that the government would like to do, but we'll only do them when the conditions allow. So again, in the March budget, Jeremy Hunt set out a policy of allowing full expensing of investments within certain investments within corporation tax. But he also said that that policy will be in place for 3 years, but he'd like to make it permanent. We have a chapter of the Green Budget coming out next week looking exactly at that policy. There's aspirations to increase defence spending, going beyond what the NATO minimum of 2% of GDP is required. The Chancellor has said he wants to get it up to 2.5% of GDP by 2030. There's a legal commitment to get aid spending back up to 0.7% of national income, which the government has said it will do when the public finances are in a healthier state. Not a formal commitment from government, but if you read last week's newspapers, you can see there's also aspirations around on other things. For example, the possibility of scrapping inheritance tax, the tax that currently raises about £7 billion a year. And on the numbers that we published yesterday, we think could easily increase to something like £15 billion a year by a decade's time. So lots of aspirations to do policies that perhaps aren't consistent with stated policy. Now, what we look at in detail in a report we published today is this issue of asymmetric responses. And what that's saying is we're looking to see how consecutive Conservative chancellors since 2010 have responded when the OBR have presented him with better news on the public finances or worse news on the public finances than what they presented at the previous budget. And we've looked exactly how chancellors respond to good news and how they respond to bad news. And what we find is that when the OBR says, well, Chancellor, in the medium term, we now think the public finances are in a slightly healthier state than what we thought a few months earlier, there's a tendency for chancellors to spend, to give away the majority of it. And they do that mainly through the form of increasing spending plans rather than cutting taxes. But when the OBR goes to see the Chancellor and say, actually, Chancellor, we think that the medium-term outlook is a bit worse than we thought in our last forecast, there's a tendency for chancellors to say, okay, I'm going to accept higher borrowing. I'm not going to offset that with higher taxes or lower spending. I'm going to let higher borrowing to some extent persist throughout the forecast horizon. And I'm just going to go through a couple of examples of when this occurred. So we've got two fiscal events at the top, October 2018 and March 2015. They're occasions when the OBR went to the Chancellor and said, well, look, we think the medium-term public finance situation has improved a bit. And then we have two fiscal events at the bottom, December 2012 and November 2022, when the OBR went to the Chancellor and say, well, we think the medium-term outlook has deteriorated. And what we can do is look to see how chancellors responded to that. So at the top, we've got Philip Hammond and George Osborne, and below we've got George Osborne and Jeremy Hunt. And what these black bars show is what the chancellor's response was in that fiscal statement that then occurred. And you can see at the top, the loosenings, so they were giveaways, and those giveaways were pretty big. In the case of October 2018, Mr. Hammond pretty much gave away the entirety of the windfall that the OBR handed him. In March 2015, Mr. Osborne, just a few months before that May 2015 general election, actually chose to give away more than the improvement in the medium-term public finances that he had been dealt by the OBR. If you look at the bottom, you see a very different picture. The situation had got worse. Policy response was to tighten, but only to tighten by a fraction of that deterioration. So in December 2012, Mr. Osborne offset a small proportion, a very small proportion of that deterioration. In November 2022, we saw a big fiscal tightening by Mr. Hunt, but nowhere near as big as the deterioration that the OBR had handed him. So the result of this asymmetric behaviour, if it continues over time, is that you end up with more borrowing, you end up with more debt, and you also end up with a bigger state because the response tends to be to spend more when you get handed a giveaway, when you get handed a windfall from the OBR, rather than to cut taxes. And what we've done is we've taken the shocks that occurred between 2010 and 2019, so we're ignoring the pandemic, and we take the responses of consecutive Conservative chancellors over that period, and we say, well, what happens if shocks continue to come along, but are equally likely to be good or bad news in the future? What would happen if chancellors respond in the same way as chancellors have done over that decade? And what we think is that on the eve of the pandemic, there's quite a wide range to the estimates here, but we think public sector net debt would have been somewhere between 3 and 11% of GDP higher, purely as a result of that asymmetric response to shock during the 2010s. So that means you end up with more borrowing and more debt. It also means that there's more of a question mark about how central the official forecasts really are. And we can show that by putting simulations around the latest OBR forecast. So this is the forecast that the Chancellor presented back in March at the time of the budget, shows the deficit falling to just under 2% of GDP in 27-28. However, if shocks come along with a similar distribution to what we've seen since 2010, but are equally likely to be good or bad news, and if chancellors respond to those shocks in the same way as what we've seen over the 2010s, we think that actually adjusting that central forecast for what we estimate to be the asymmetric policy response would push the deficit up in the last year by 1.4% of national income. We'd be forecasting a deficit of about 3% of GDP, not 1.8% of GDP, so a considerable difference. And in fact, by doing 10,000 of these simulations, we can look at the chances that borrowing turns out to be more or less than what the OBR central forecast suggests. And we think that on the basis of these asymmetric responses, there's about a 90% chance that borrowing will be greater than the central forecast that the Chancellor presented back in March. So to conclude, we know that bad shocks are bound to come along, and that's a key risk to the public finances. Unfortunately, it does seem to be the case that bad shocks seem to come along more often than good ones. But even if good ones and bad ones came along with equal regularity, so you'd expect them just to cancel out perhaps in terms of their effect on the public finances, we think you'd still see borrowing and debt ratchet up over time because of the asymmetric way to which chancellors respond to them. They can't resist the temptation to engage in spending increases with a bit of tax cuts when handed windfalls, and they're much more reluctant to offset deteriorations in the public finances with tax rises or spending cuts. So policy risks appear to us to be skewed towards higher spending and lower revenues, more borrowing and a bigger state. That suggests that the public finances are probably in a weaker position than what the official forecasts suggest. With that, I'll hand over to Bruna, who's going to talk about our financial market considerations. Thank you.
Thank you so much, Carl. So from my point of view, exactly, I will try and talk about financial markets' response to all of this. So rather, I will really try and talk about the primary concerns of gilt market participants specifically, highlighting, I would say, three main points. The first one concerning near-term increase in gilt supply. The second one, pretty dramatic changes in terms of demand conditions in the gilt market. And the third one concerning fiscal stability, which gilt investors are looking for at the moment. As I said, the first point I really want to zoom in concerns near-term gilt supply considerations. Both Carl and Richard, of course, talked a lot about the medium-term risks and medium-term trajectory for debt to GDP path. But financial markets are more concerned really about the near-term gilt market considerations. And with that, to set the scene, I think it's important to highlight that we are in a new gilt supply reality now, where we have a sharp and seemingly persistent increase in the amount of gilts that market participants are expected to absorb in the next couple of years. And when I say market participants, I do mean private sector market participants. The second chart on the slide in particular shows that it is not to say that we have not had fiscal policy easing in recent past. Of course, we had in the aftermath of the GFC. Of course, during the COVID shock, we had meaningful increases in gross gilt issuance. But at the time, we were in different economic environments. Inflation was very low. It was below 2% target. Interest rates were close to the effective lower bound. And the Bank of England was purchasing gilts as well within its inflation targeting remit, conducting, of course, quantitative easing programs. This is no longer the case. The Bank of England is now a seller rather than a buyer of gilts. And this issue of the missing marginal buyer is one that I will return to in a couple of minutes. But as we are to see two major fiscal events in the next 6 months, of course, the autumn statement and the spring budget as well, I think it's important to highlight that beyond the medium-term trajectory of debt to GDP ratio, the very near-term focus of the market really already is on the very elevated gilt supply that awaits. Indeed, as Carl just mentioned, what has been particularly interesting in the last couple of fiscal events is the dichotomy between near-term measures and medium-term pledges. For example, I think November 2022 is a particularly good example of this type of policy, where the bulk of the fiscal consolidation that was required for medium-term fiscal targets to be met was, of course, delivered beyond March 2025. This has meant sizable cuts to current spending envelope being promised for 2025 and beyond, but near-term plans were only mildly altered, and so we were left with near-term, as I've mentioned, elevated level of gilt supply. Indeed, as the OBR pointed out, and Richard in its fiscal risk report from this July, and the third chart on this slide shows this, what governments tend to do when it comes to departmental spending, multi-year spending reviews, is really set very tight spending growth assumptions in the year beyond the current spending review period, and then ultimately revise these totals up when the time comes for departmental plans to be set at the next spending review. As Carl pointed out, we now have a number of policies that are initially announced as temporary, but have historically proven to be fairly challenging to reverse. Fuel duty freeze, of course, is the most obvious one. As Carl mentioned, we have the 100% capital allowance or full expensing regime that has been announced as a 3-year policy, with the intention of the Chancellor to put this in place over the long run as well, if, as he mentioned, longer-term fiscal considerations allow for that. Now, all of this is to make the first point, which might seem fairly obvious, but perhaps goes unsaid very often, is that while medium-term pledges matter more for fiscal framework compliance assessment, the reality and the certainty of near-term gilt supply is something that the market focuses more on. Now, that increase in the supply that private sector participants are expected to absorb is happening, as I've mentioned, in a new reality for demand for gilts as well. So this theme of the marginal buyer is the second one that I would like to spend a few minutes on, really highlighting that the shift in supply is happening, as I've mentioned, in different demand conditions. The first issue, of course, is the one that pertains to defined benefit pension scheme activity. It has historically been a very meaningful boost to the gilt demand. Over the course of the last decade, the gilt market has seen about £1 trillion of asset transfer from equities into fixed income. This de-risking becomes very clear from the rising proportion of fixed income assets within DB scheme portfolios, which you can see from this rising yellow bar in the second chart on this slide. But as gilt yields rose in recent years, especially last year, the funding ratios of DB schemes rose as well. Despite last year's issues with liquidity, funding balances of DB schemes are now very healthy. These schemes, of course, are largely closed for future accrual as well, and improved funding positions are normally accompanied by interest rate and inflation hedging activity. These schemes are looking to become fully hedged and essentially to be bought out by insurance companies. This past year, I should note, PPF flagged that funding level gains that we've seen over the course of the last year have not been accompanied by the same level of interest rate hedging and inflation hedging activity, as of course schemes have sought to review their funding, investment, government arrangements in the light of the volatility that we've seen in the leveraged LDI market this time last year. A broader interest rate volatility probably didn't help LDI demand either. But in any case, over the medium term, our gilt strategist here at Morgan Stanley assesses that there's about £300 billion of LDI de-risking that still awaits. This is the total residual money that's there for de-risking. And once that is done, there will practically be zero additional pension demands for longer dated gilts in particular. So this is a meaningful pillar of the gilt market that is now on the way out. Of course, the second part of this is the Bank of England. The second part of this change in the broader demand conditions. As I've mentioned earlier on, since 2009, the bank has played a crucial role in stabilizing the gilt market via QE purchases. The BOE is now a seller of gilts. Just last week, they've announced that over the course of the next year, the pace of their QT program will be £100 billion. That's £50 billion in passive roll-offs for shorter date gilts that they hold, that they will roll off their APF portfolio. But of course, £50 billion of active sales will be conducted as well, and they do it in even terms in terms of the bucket split of the proceeds, so shorts, mediums, and longs as well. And I think the crucial additional point, which is worth highlighting, is that these LDI funds and the Bank of England they're pretty price insensitive. They were pretty price insensitive buyers of gilts. The Bank of England, as mentioned, conducted QE purchases within its broader inflation targeting remit. And as far as LDI is concerned, the demand there was broadly related to hedging their longer term liabilities. But in this new environment of very elevated supply and differing demand conditions, gilts become more exposed to cross-market considerations. So we are looking to entice foreign buyers, for example, to come into the gilt market and purchase gilts. And with that, it's important to consider, are gilts actually an attractive asset class for foreign investors? One way of doing that is looking at the cost of currency hedging and looking, of course, at the level of yields of gilts relative to other comparable government bonds, and on the calculations that our and the strategists have done, gilts actually don't look that cheap compared to, for example, French OATs or US Treasuries. They look cheap compared to bonds. They're, of course, trading richer than Italian BTPs, which you would expect in broader market, normal market conditions and normal market scenarios. I think the final point really ties into the second point well, which is to say that gilts, like any other asset, will find a buyer with the right price. But the lack of price insensitive buyers of last resort, like LDI, like the BOE, does mean that we're more exposed to cross-market appetite and perhaps volatility in gilt yields. So financial markets perhaps become more of a constraint to take into account when making fiscal policy choices. And this really is the final point for me, that fiscal policy ultimately, of course, is in the hands of policymakers, with financial markets acting as part of the broader framework within which they operate in. On the assessment of medium-term risks, on near-term supply, on cross-market opportunities, investors will look for a rate of return for investing in the UK. But as is the case with corporate investors, financial market investors do value stability as well. So with that, perhaps noting that avoiding some of the volatility that we've experienced over the course of the past year would also be valuable in trying to attract, especially foreign buyers, into the gilt market. So with that, perhaps I can finish there and hand it over, I believe, to Paul to perhaps kickstart the debate.
Thank you ever so much. Fascinating set of presentations, if not ones that are going to help me sleep well this evening. There's quite a number of questions. I want to start actually with a series of questions, and I'm going to, at least in the first instance, direct this at Richard. Series of questions about the role of QE and the Bank of England. And these are questions that we often hear, and it'd be really helpful, Richard, and then to the extent that Carl and Bruna want to come in, you as well, to get your response to questions that often come up and have been put in the chat. The Bank of England holds whatever it is, 800 billion worth of debt. That it's just another part of the public sector. Is that real debt? Does it ever really need to pay it down, to offload it? And does it in fact even need to pay interest on it? Is this a different kind of debt to the other debt? And are we worrying too much about it? Or is this stuff that really has to be treated as it is being treated as real debt?
I guess the best way of thinking about it is, from a fiscal point of view, is that the Bank of England is just a wholly owned subsidiary of UK PLC. And so to the extent that it's holding government debt, that kind of gets consolidated out of the overall picture. I think the challenge from a fiscal point of view is that because the Bank of England has been buying up long-term debt, and that was the original objective of QE, which was to try and affect interest rates at the long end of the curve, so 10, 20, 30 years out, because the Bank of England already had a lot of control over short-term interest rates. It was trying to affect long-term interest rates. It was buying long-term government debt, which was one of the reasons why we felt assured about not worrying too much about rising interest rates, because it took a while to feed through the debt stock. The stuff to worry about from a fiscal point of view is that it issued short-term debt in order to finance those purchases. So in effect, it sort of refinanced long-term liabilities of government and replaced them with short-term liabilities of the UK public sector. They're just liabilities of the Bank of England rather than the Treasury. Because those gilts sitting in the Bank of England are just paying interest back to the Treasury, because has a 100% government guarantee. In effect, from the perspective of the outside world, they've just given up a long-term asset and been given a short-term asset, and that's why the public finances are a lot more susceptible to short-term interest rate rises. The thing which is happening now, because the Bank of England is reversing quantitative easing and going into quantitative tightening, is that process is now running itself in reverse. So the risk to the public finances of the shortening of maturities that came with QE is now being undone as QT happens, because more of those gilts are going back into the market, either because the bank is selling them, or they're just rolling off and maturing, and the Treasury is issuing long-term debt. Or that it's actively selling those, and so that's making the average maturity of the UK public sector's debt rise over time. But it's taking time to get there, and it's certainly happening more slowly than interest rates have been rising, which is why we've seen that big hit to our interest rate costs in the near.
Right, Bruna, Carl, would you like to add anything to that? Because I think this is an issue that I think many other people find quite difficult.
Sure. I'm so sorry, Carl.
Go ahead, Bruna.
Very, very briefly from my point of view, I think one of the questions was, does the Bank of England have to sell these gilts? And of course, the answer is the Bank of England doesn't have to do it, the same way the Bank of England doesn't have to hike or cut interest rates. The Bank of England is doing what they think will most likely lead to them attaining their remit, which is achieving the 2% inflation over the medium term. And so I think it's important not to conflate, let's say, the fiscal consequences of monetary policy choices, which are wholly independent, as the Bank of England is an independent institution. So, of course, during the QE program, I believe it was £120 billion worth of proceeds that the APF transferred over to the Treasury, as it was at the time a profit-generating operation. And I believe it was Ben Broadbent who, at the Treasury Select Committee, said that he was not under the impression that in any case impacted the broader fiscal consideration or fiscal policy choices. But in any case, it was a decision that the Bank of England was undertaking at the time because inflation was below 2%, interest rates were close to zero, and there's very little that the bank could do apart from QE in order to stimulate the economy. At the moment, interest rates, of course, are rising because the Bank of England wants to get inflation down, but also another set of policies that they're undertaking, which is active sales, is to use the balance sheet as a counter-cyclical tool. So in an environment that we're in now, they want to ensure that they draw down on their APF holdings. So if we have another crisis, like, for example, we had in March 2020 when we had that for cash, the bank has more balance sheet capability in order to come into the market and stabilize the gilt market again. So I would say that it's important, perhaps, as I've mentioned at the start, not to conflate fiscal and monetary policy, where the Bank of England does act as an independent operator, and that should be the case moving forward, but there are just considerations, of course, for fiscal policy to take the consequences of those actions then into account. Yeah.
I agree with all that. I think one thing I'd like to add is, Paul, you said that you asked explicitly whether the bank should be paying bank rate on those deposits. And I think if you look in last year's Green Budget, there's a chapter written by Sir Paul Tucker on that. He looked at the issue. I think that the way I see it, at least, is that the Bank of England borrowed money from people on particular terms. I think it should be very wary about changing those terms, having borrowed that money. But I think before we engage in QE in the future, we should seriously think through what the terms of doing it again should be. And for example, one could imagine a world where the bank said very clearly up front that if we do QE in future, it might be that we want to pay bank rate, but maybe what we'll do is pay, for example, zero on those deposits. And that's certainly something that the Green Budget last year recommended was given serious consideration for any future occurrence of the need for QE.
Right. That's that was a really helpful conversation, and hopefully that has cleared up some of the questions that people in the audience will have. I think the next question, Richard, is fairly directly aimed at you. Is there any practical alternative to the OBR taking government policy as given, in particular in circumstances as we've been looking at, where it's pretty frankly obvious that government policy isn't, or at least isn't the central expectation for what might actually happen?
I think it is the case, and as Carl and the IFS papers highlighted very nicely, that there are in effect a set of downside risks built into our forecast, because you've got an assumption about fuel duty rates, which are unlikely to be realized. Carl and Bruna highlighted the points about how departmental expenditure tends to get revised up as spending reviews approach. And one thing to bear in mind is that our next forecast is going to have 4 out of the 5 years without a detailed set of spending plans supporting them. And not surprisingly, they are, at the moment set to fall as a share of GDP. As there's also, a tendency to announce measures as being one-off, but then extending them, like was done with capital allowances. And also, it's important to bear in mind that the rolling nature of our existing fiscal rules means that the government's target is to get debt falling in 5 years' time. But you always get an extra year as we roll a year into the future. So the government always gets an extra year to get debt on a falling trajectory, and that means that it always has a bit more money to spend every time you move a year ahead. So there's sort of inherently an upward bias toward borrowing, and we've seen this when we looked at our own forecasting record, which is that we do tend to under forecast borrowing over the medium term, and one of the biggest single reasons is these upward revisions to government spending plans. There was an interesting precedent set in our last forecast, and it was in response to the fact that our forecasts have to serve 2 constituencies. One is the government in putting together its budgets, but the second is Parliament to help them understand the impact and nature of the government's fiscal policy. And what the Treasury Committee explicitly asked us to do was to present the public finances on 2 different bases with respect to fuel duty. One is where we put in our forecast the government's stated policy of indexing fuel duty to inflation, but also one where our forecast actually followed the government's revealed preference, which is to either freeze or cut fuel duty. Cut fuel duty over the forecast period. And so for the first time, we actually restated our forecast on 2 different bases. One where we followed stated government policy, but the other where we followed revealed government policy, which is to freeze fuel duty. We did that because Parliament made that specific request. And I think that meant that we wanted to serve one of our most important constituents. I think we'll kind of await what Parliament thinks next about our next forecast before we make any decisions about it.
Can I ask a question directly then? If Parliament or the Treasury Select Committee were to ask you to produce a set of forecasts which encompassed your best judgment as to actual likely increases in spending, for example, would you do that?
I think we'd have to reflect on that in light of what the legal framework says. The law says that we have to follow stated government policy, but it also says that we need to have our best view of a central forecast. And I think in the case of fuel duty, it was very, very evident what revealed government policy is on fuel duty, which is that they freeze it. When you're looking at something like the path of public spending, it's more complicated because there have been periods where the government has been reducing public spending as a share of GDP. We saw that sort of post 2010. More recently, the government's revealed preference has been to stabilize or increase public spending as a share of GDP, and we know there are lots of pressures on it. But it's not as immediately obvious when you're talking about something as large as every single government department in the country what revealed government policy would be. Whereas in a more narrow area like fuel duty, it was obvious. And look, they always say they're going to index it, but in fact, what they do is freeze it, and you saw it very clearly in the chart that Carl showed.
Carl, any thoughts on that?
Yeah, I mean, I can see with Richard's point that with fuel duty, it's very easy to see an alternative model of what government behaviour might actually be, which is just to freeze it. And I can see it's a bit more of a challenge in other areas. I think that the problem is, perhaps not surprisingly, politicians are very keen to point out where they have aspirations to do things which are nice things, and they're probably not very keen to point out the tax rises or spending cuts they might be thinking about should they have to do them. So if we don't start thinking about those tendencies, we're always going to end up, I think, with a bias in one direction. I mean, another practical thing, and this is something for chancellors rather than the OBR that could happen, is that the asymmetric responses we see become worse the more often you have fiscal events, because you give it less chance that some good news gets unwound before the time you get to an event. So one thing a chancellor who was trying to resist the temptation to spend giveaways could do would be to announce that we are only going to have one budget a year, and we won't be having 2 major fiscal events in normal circumstances, which indeed is what Gordon Brown and George Osborne said they were going to do when they started their tenures as Chancellor. And I think that could be an improvement too.
Great. Look, there's a really nice question here, which I'm going to ask you to respond to first, Bruna. Given that a lot of the risks that we've been talking about are global, climate change, aging, security, is it not possible the bond markets will give the UK government some leeway in the sense, as they did with the pandemic? In other words, if every country is facing these same sets of risks, is there any reason to believe that we are going to have particular problems, or might we think that actually we'll be treated alongside every other country? And I'm sure if we were talking about France or Germany or where have you, there'd be a lot of worry about the future cost of pensions and similar worries about some of the other things that we're talking about. Are we overdoing the risk here by being a little bit parochial?
I think there's a few kind of things to highlight here. The first one, of course, is that the starting position matters. If you look at a country like Sweden, for example, their debt to GDP ratio is, I believe, around 30%. So we're at above 100 in terms of the OBR's projections. If you look at Germany, I think they're at 60%. So there is a bit more fiscal space in terms of what the market can absorb relative to the size of the debt of those countries. France, I believe, is at comparable levels as the UK. Of course, UK has a big current account deficit. As a nation, we don't save a lot. So we actually need those foreign inflows to come into the UK and to mop up our debt. And as I say, that is particularly pressing in an environment where we don't have domestic buyers of last resort, like I've mentioned, DB schemes or the Bank of England. So we are a little bit more, let's say, exposed to kind of cross-market opportunities that global investors can assess. If they assess that the return to, let's say, German bonds is higher when you adjust it for risks and when you adjust it for currency considerations as well, it's going to take for some market adjustment for those foreign investors to come into the UK, whether that be a decline in net supply in the near term or just an increase in gilt yields, for example. Those are the mechanisms through which you get that adjustment. When it comes to the US, of course, well, they're the reserve currency of the world, so they have a pretty privileged position, and we unfortunately can't compete with them and can't really compete with that. So I do think that there are some specific vulnerabilities that the UK has in terms of the starting point and in terms of the reliance on foreign investors that make us a little bit more vulnerable than, for example, some of our more comparable peers, even if the nature of a lot of the risks that Richard talked about, as you've mentioned, demographics, COVID, post-COVID recovery, etc., are more global in nature, and that perhaps explains why in the aftermath of the energy shock, for example, foreign investors were particularly focused on the cost of the energy support programs in the UK relative to what was done in Europe, for example, where we had generous support schemes, but those were more easily mopped up by their government debt markets.
Richard?
I think it is the case that interest rates have risen all over the world, and lots of countries all advanced economies are facing demographic problems, some more rapidly than we are, including Japan. I think that we are more exposed because of the structure of our debt. And I think as Bruna highlighted, there are fewer reliable investors than we used to be able to rely upon as demanders of that debt. So and I think we saw some of those factors come together last autumn in terms of how quickly market sentiment can change, especially when a lot of your debt is now in foreign hands rather than domestic hands, because those are people who are looking at kind of UK PLC as a whole as an investable proposition. They're not particularly wedded to buying assets in sterling. They're not particularly looking for safe assets in sterling. They're looking for safe assets globally, and those might be in dollars, they might be in yen, they might be in euros.
So I think in a way, getting to the core of this question and the extent to which what we've been talking about here is a real constraint. There's a question here which essentially asks, what is the risk that the markets will actually limit government's ability to loosen fiscal policy over the next, let's say, over the next parliament? I mean, this is clearly, in a sense, the big issue as we come up to the next election. Both parties say that they are committed to fiscal rules, which broadly speaking mean stabilizing debt or getting debt down. But supposing you did have a party that either explicitly or in practice ended up loosening fiscal policy and raising debt a bit. To what extent are the things that we've just been talking about actually going to constrain their ability to do that? I mean, will the markets punish a government that tries to run a fiscal policy that is noticeably looser than the fiscal policy being run at the moment? Who'd like to start on that one? I mean, Richard, in a sense, let's start with you.
So one thing I'd say is that what's happened on markets is already constraining government's fiscal choices, in that the government, what the government is already paying to service its debt, has more than doubled. It's now second to the NHS in terms of a spending item in the public finances. Its costs have just risen enormously over the past few years, so it's already consuming a lot more government resources than our forecasts back in 2020, back in 2019 were forecasting. So a lot more of what the government is raising in tax, it is then just sending straight back out into the markets and interest payments, and less of that is available to go on public services. So I think market conditions are already acting as a very significant constraint on fiscal policy now. And I think the other thing, which both the events over last year, but also the work that institutions like the IMF have done, is that market sentiment can shift remarkably quickly. And so countries can go from having very favorable ratios of what is called R minus G, which is the ratio of their interest rate to their growth rate. They can go from having a very favorable ratio of those two things, interest rates well below their growth rate, to markets, to those things suddenly shifting when market sentiments change, and governments suddenly being charged a premium because people think something's changed about the nature of fiscal policy making. People think something's changed about the nature of the economic and fiscal outlook for the country. And so those dynamics can switch remarkably quickly, and countries can go from looking sustainable with one configuration of interest rates and growth to suddenly looking unsustainable with a very different configuration. And those differences can happen much more quickly than people think.
Bruna, how do you think the markets would respond if the government came out and said it wanted to borrow, 1% of GDP more per year over the next few years?
Yeah, I mean, I completely echo Richard's point. We're already seeing the market reacting to the increase in supply and, let's say, looser fiscal policy over the course of the next few years in the aftermath of the Russia-Ukraine war and, of course, COVID. And any future government that would want to ease policy further would have to accept that debt servicing costs would perhaps rise even more. Now, in terms of how the market will react, I do think that there is an element of, we need to think a bit about what exactly is that 1% of GDP going towards. For example, you can have a situation where the economy is already running hot and there's an additional layer of, let's say, tax cuts that are provided, or perhaps increases in current spending, which are not seen as supply expanding, in which case the market very easily deduces that this kind of behavior could make an inflationary problem even worse, and the Bank of England would have to hike rates in order to dampen excess demand. And so you essentially have much higher gilt yields. Then, for example, if you have supply side initiatives that the government is undertaking in order to expand the productive capacity of the economy to try and resolve, for example, labor supply issues that we've had over the course of the recent years, the reaction might not be the same, because ultimately it would be seen as fiscal policy working hand in hand with monetary policy in order to try and create a little bit more slack in the economy further down the line to resolve the inflationary problems that we might have. So I think it's also important to think about the nature of the policy announcements, because that can direct the gilt market response quite meaningfully as well.
Carl.
Yeah, I think the only thing I'd add to that is that you've got to think exactly through why is the borrowing going to be higher. I mean, if it's a shock, is it a global shock? Might it be associated with lots of people being very keen to save in safe forms? We saw that during the pandemic. The governments could borrow incredibly cheaply at that time. If it's a deliberate attempt through UK policymakers to push borrowing up despite a shock, what's the story they're telling? Is it a convincing one about why this is sustainable and the right thing to do because it's a productive thing to be doing? Or is it just going to be stoking more inflation? If it's a shock and a UK specific shock, we might be very worried then, because it will be the kind of world where people won't suddenly be keen to lend the UK government money, even though it might feel it needs it. And actually, that's probably one of the strongest reasons for governments to aim to get debt down over the medium term, just because there's a chance at some point we get a nasty shock that's very UK specific, and we want to have the headroom to borrow through that to support public services, households and businesses through that difficult time. And we don't want to run out of room to maneuver.
It's not quite the topic that we've been talking about, but there are several questions about the structure of the fiscal rules. One specifically asking, are there examples of better fiscal rules elsewhere? And a couple asking how we might better construct, or whether there are different or better ways of constructing our fiscal rules. Carl, this is your specialist subject, so I'll start with you.
So I think there's a lot of attractions around a kind of fiscal rule that says we will aim to only be borrowing to invest over the medium term. So that's essentially a variant of the fiscal rule that the coalition government had between 2010 and 2015, and it's not that different to what the Labour government had before it. And I like the forward-looking nature of it, because it says, well, by going to try and get there in, say, a few years' time, you can look through any shock, any nasty surprise can work its way through the system. If you have got to make adjustments, you've got a bit of time to adjust. And I like the fact that it says, well, actually, we're going to treat borrowing that's financing day-to-day spending very differently to borrowing that's financing investment spending. So I think lots to attract us about that. It still has that flaw that Richard pointed out, that, of course, if you're saying I'll run a current budget surplus in 4 years' time, well, you never actually get to 4 years' time. And you have to worry about policymakers just promising tax rises or spending cuts that they've got no intention of delivering. But I don't think that's insurmountable. I think the OBR, the IFS and others can point out when those targets are being gained. But alongside that, we probably do need some kind of limit on debt, or some kind of limit on what we're prepared to spend on financing debt, because on its own, a limit on borrowing borrowing only for investment doesn't provide any cap on debt. So I think alongside that, we probably do want some longer term objective to get debt down, or some limit on what we're expecting to spend on debt interest. I think it's much harder to design that kind of rule in a way which is flexible enough, which makes economic sense, and yet can't be gamed by policymakers. I think that is a very tricky thing to get right.
Richard, are you allowed to answer questions about the design of fiscal rules, or perhaps you could? You know a lot about other countries. Are there other countries you'd like to direct us towards?
So I'm not allowed to express opinions about fiscal rules, because it is my job just to assess the rules that we have on a given day. I do, having looked at lots of rules in previous lives, I mean, one thing I'd say is there's no perfect rule. Every rule has advantages and disadvantages. And as Carl said, rolling rules have the disadvantage that you never get there. But if you look in the Eurozone, they're struggling with the fact that in principle, they've still got a rule saying you've got to have debt below 60% of GDP, but most of their major economies have got debt far above it, and they're a long way from ever getting back. So that kind of rule is not really binding on countries like France and Italy. So kind of what do you do in that sort of situation? So, firm rules are great until you break them. Rolling rules are great, except for the fact that you never get there. And so they all have advantages and disadvantages. I mean, one thing that we've had in the UK, and it relates to the point that Carl was making about risks being skewed to the downside, is that Carl highlighted that there's anywhere between 3 and 11% of GDP in downside risk to a given forecast for the public finances. And one thing that the UK has never done well, regardless of the fiscal rule it has, is basically aim off for that fact. We tend to not leave ourselves enough headroom, enough room for maneuver to ensure that we can meet those rules with confidence. And to give you an illustration, Carl highlighted between 3 and 11% of GDP worth of downside risk in the public finances. The headroom that the Chancellor is holding against his fiscal target is 0.2% of GDP at the moment. So it is just an order of magnitude smaller than what we know to be the risk to the outlook in the medium term. So I think whatever rule you set yourself, chancellors never seem to aim off enough for the fact that they know the risks to the delivery of that rule are skewed well to the downside.
Bruna?
Yeah, I mean, I think one kind of interesting example of what happened in the recent fiscal statement was the full capital expensing, for example, which was delivered for 3 years. And I believe the explicit aim was, as mentioned, to have it as a permanent tool if fiscal considerations allow over a longer period of time. And so that allowed, of course, the government to say, well, partly that, kind of tapering off after 3 years, to say that within 5 years' time, we'll have this small amount of fiscal space left, and our fiscal targets in the medium term will be met, but in the near term, we're stimulating the economy, which is all, of course, fine and well. But if you think about investors in the UK that are looking to invest in longer term projects, so multi-year projects, for example, investors in renewable energy, etc. Some of my equity research colleagues were telling me that bigger corporates were counting on this deductible becoming a permanent feature of policy, and they can't really plan by being told, we'll keep it in as our policy choice for 3 years' time, and then we'll remove it, and then maybe we'll bring it back if we can. So it's just about the stability of policy choices that are being made, and not trying to kind of reverse engineer policy choices from the fiscal targets that we have. I don't think that's necessarily the right approach. But I mean, apart from that, one specific example in that point, I do agree that most of the countries that we observe have a certain debt and borrowing rolling borrowing rule, and UK is really no outlier in that sense. But it is more about prudent policy choices that are not being made just for the sake of meeting that target 5 years down the line.
Great. There's a sort of rude and direct question here, Richard, about the accuracy of your forecasts.
Oh, yes. So, for people who are really interested in the accuracy of our forecasts, we both produce a report once a year looking back at our last forecast that we did the year before. And then we've just put out a few days ago a report looking back at our entire forecasting record since we were set up back in 2010. We compare ourselves to the Treasury when it was its track record of forecasting before 2010. We compare ourselves to the Bank of England. We compare ourselves to other independent forecasters out there, including the likes of Morgan Stanley. And we also compare ourselves to other official forecasters elsewhere in Europe. And what it does show is that our forecasting record is not bad by comparison with those other forecasters. Our forecasts were on average, more accurate and less biased than the Treasury's forecasts before, but mainly in the near term. Over the medium term, we've really faced two challenges. One is that, especially coming out of the financial crisis, we tended to overestimate the trend rate of GDP growth and productivity. I think, like a lot of economists, we thought that productivity was going to return to its pre-financial crisis rates. It just never has. We've had this period of stagnation. It took us a while to revise down our view of the growth potential of the UK economy towards something more central. That drove a lot of our forecasting errors at the beginning of that period. More recently, most of our forecasting errors on the fiscal side have actually been driven by this exact point, which is that governments tend to have basically overly optimistic plans for reducing the level of public spending, and then they top them up when spending reviews come along. And that's added, as Carl said, on average, anywhere between 10 and 20 billion pounds, the level of public spending in the medium term. And that's meant that our fiscal forecasts have tended to be over optimistic about where borrowing is going to end up, and borrowing ends up significantly higher than we set out in our initial 5-year forecast. But you can read more in a really, really good paper on our forecasting record if you want to find out.
I mean, on average, despite the relatively gloomy outlook you're giving us today, I think it's fair to say that the OBR has been over optimistic. I mean, a sort of a cheerleader for the economy rather than the gloomsters and doomsters that you're occasionally blamed for being.
That is true. On average, we're more optimistic about growth and about borrowing than where we end up.
Yeah. So so the bad news, everyone listening, is that despite all of what Richard's been saying, that's the optimistic take on what's going to be happening over the next few decades. We're coming towards the end of the event. I mean, there's one very sort of one very nerdy question here, which I just put, I guess, to Richard. Does the about dead interest spike? Is the way we account for it on accruals accounting? The fact that we're doing accruals accounting, is that creating the spike? And do other countries do things in the same way? And then essentially, is there a bit of a bit of a mirage here that this is just created by the way that we do our accounting?
So you do see in our debt interest forecast a big spike in kind of 1 year, and then it settles back to a high level, but not the peak of the spike that you see in the year in which you have an inflation increase. And that is because of the way that rises in inflation affect the accrued interest on our inflation-linked debt stock, but that 1/4 of the debt stock that I highlighted in my presentation. And that is because that change in the inflation outlook is entirely reflected in the value in the interest cost of that debt in the year in which you have the inflation surprise. And that is because you recognize the inflation surprise in the year in which the event happens. And it is in the long run a real phenomenon, right? That that debt is now the value of that debt has now gone up by the value of the higher level of inflation, but it gets reflected in our interest costs in the year it happens. Most other countries do, if they follow national accounts rules, account for debt interest in that sort of way. The issue is we just have a lot more inflation-linked debt, and so you see a much bigger hit to our interest costs when you have inflation surprises than you find in other countries. But it is the case that the actual cash interest going out the door of the debt management office in the form of coupon payments to individual investors is not as high as the accrued interest that you see in that year, because that's reflecting the increase in the overall cost of inflation-linked debt over the life of it.
And in terms of policymakers, it seems to me that actually, perhaps we don't need to worry too much about the one-off spike. We should worry a lot about the fact that it ends up at a higher level than what we've been used to in the past and what we were previously expecting. So we shouldn't be ignoring the fact that debt interest is higher. We probably can look through the spike, but worry a lot about where it's forecast to end up.
Okay, we are in the dying moments. I'm not going to ask about realistic tax reforms, which could change the trajectory, because we'll be talking about that a lot in future Green Budget events, and indeed as we come up towards the election. But I did just want to finish on this question here about whether if the question is, do governments that want to borrow to invest need to forecast the impact on growth and GDP to be credible, which I think is again, I think going to be quite a central question as we particularly come up to the election. There will be claims, as there are always claims from politicians, saying that they will get the economy growing. Given that they'll get the economy growing, then the debt and borrowing burden will come down. And Richard, you'll know that the Prime Minister, as of a year ago, made quite a lot of the idea that the OBR wasn't dynamic enough in its forecasting, and if you only added some dynamism to your forecasts, they would show that things like tax cuts and investment spending increases would see GDP growing into the future, and therefore debt and borrowing as less of a problem. Can we? I'll ask Richard first on that, but if Bruna and Carl could also think of their thoughts on that, and we'll wind up after the answers to that question.
So I think forecasts should definitely take account of what are credible estimates of the growth impacts of policy changes, and our forecasts do take account of the supply side or growth impact of both tax and spending policy changes. And we actually put a paper out last autumn on how we do that modeling and how we do that so-called dynamic scoring. This has been facilitated, I should say, by some real improvements in the way the ONS put together our economic data, because we can now track things like, we've got a model of the total economy's capital stock, we've got a model of the economy's labor supply. And so if governments do things like change tax rates, which increase the labor supply, that can be taken into account in the way we do growth accounting. If it brings more people into the workforce, that's more taxpayers, and that can help offset some of those costs of a tax reduction that brings more people into the workforce. And then on the capital stock side, if governments increase public investment, or they do as they did recently, which is reduce taxes on private investment, that can boost the capital stock. That increases the productive potential of the economy. Our forecasts have captured those effects in the recent past, using the kind of accounting framework which the ONS has now developed, which allows us to track these stocks and how they evolve over time and how they're affected by changes in things like the flow of public investment as well as the flow of private investment.
Yeah, absolutely. I mean, I think to use a few examples in recent years, the expansion of childcare policies that was provided in the March statement was accounted for very clearly by the OBR in terms of the increase in the participation rate further down the line when the policy kicks in. and OBR's assessment of participation rate, I believe, is higher than what the Bank of England at the time was saying would be the case in those years, partially because OBR had taken into account the impact of higher, I believe, female participation on the labour participation more broadly. And then again, to kind of end up on the note of OBR being a bit more optimistic than it seems, I believe when the super deductible was introduced a few years ago by the then Chancellor Sunak, OBR's assessment on a near-term capex growth was far more optimistic in Italy than the actual policy ended up yielding. So I think, you know, I can only echo Richard's words. The obvious impacts of policies are accounted for, and yeah, if recent examples have shown anything, is that the OBR perhaps is a bit too optimistic in terms of some of those policy impacts.
Anything quick to add, Carl?
I mean, I'd agree with Richard and Bruna that obviously when these policies come along, we want to think about all of their impacts and try and account for what role they might have on the supply side of the economy. Of course, then when you're trying to think about, well, what does that mean for growth going forwards and how does that compare to the growth we've enjoyed or otherwise historically, you need to think about whether the government's doing more or less than what has normally been the case. We've often had governments do regulation, tax, competition, planning, immigration, investment reforms to try and boost growth. So even if your government's doing reforms and getting more growth as a result of those reforms, that doesn't necessarily mean you'll get more growth than we enjoyed in previous decades.
Well, thank you all very much. Fantastic set of presentations. Thank you everyone for tuning in. If you want more fiscal stuff, we have our main green budget law on the 17th of October, and I can promise you a great deal more fiscal stuff, analysis, insight, projections, and in particular, a view of the situation the Chancellor will find himself in come the autumn statement. So do tune in on the 17th. Thank you everyone for listening and watching.